Have you ever entered a trade that looked absolutely perfect? The trend was obvious. Price was making higher highs, higher lows. Everything looked exactly the way trading books tell you it should. So you clicked buy. For a few moments, it even moved in your favor. Then something changed, the market slowed down. Momentum disappeared. Price started moving sideways. Maybe it reversed completely. And suddenly you were asking yourself, what did I miss? Here's the truth. Most traders don't lose because they can't identify a trend. They lose because they can't recognize when that trend is running out of strength. Those are two very different skills. Price can continue moving in one direction, while the energy behind that move quietly disappears. And if you only watch price, you'll probably never notice it. Professional traders think differently. Before they ask, where's price going? They ask, does this move still have strength? That's exactly what today's lesson is about. Not another trading indicator, not another magic signal, but a way of measuring the hidden strength behind every trend. Today we're learning one of the most misunderstood indicators in technical analysis. The Average Directional Index, better known as the ADX. By the end of this lesson, you'll understand not only how to use it, but more importantly, how professional traders think before they commit their money to a trend. Let's begin. Chapter 1, the chart that tricks most traders. Let's put theory aside for a moment and look at a real chart. Imagine this is the first time you've seen it. No indicators. No analysis. Just price. Take a few seconds and ask yourself a simple question. Would you take this trade? Most traders would answer, yes. The trend is obvious. Price is making higher highs, higher lows. The market looks healthy. Everything appears to be moving exactly as it should. Now imagine you've just entered the trade. For the first few candles, price continues higher. Your confidence grows. You begin thinking about your profit target. Maybe you even consider adding another position. After all, the trend still looks strong. But here's the question professional traders ask. Has anything actually changed? Or, are we simply assuming the trend will continue because that's what we want to believe? This is where psychology quietly takes control. Once we're in a trade, we stop looking for reasons to stay objective. Instead, we begin searching for reasons to prove ourselves right. Every bullish candle feels like confirmation. Every small pullback becomes just a retracement. And every warning sign becomes easier to ignore. Not because the chart changed, but because our mindset changed. Professional traders understand this. They know that confidence can become dangerous, especially when it isn't supported by evidence. That's why they don't rely on price alone. Price tells them where the market has been moving. But they also want to know something deeper. Is the strength behind this trend increasing, staying healthy, or quietly fading away while everyone is still celebrating higher highs? Because sometimes, the most dangerous trades are the ones that look the safest. And that's exactly where the ADX begins to reveal information that price alone cannot. Chapter 2, Understanding ADX, Measuring the Strength Behind the Trend. So, how do professional traders measure something we can't actually see? The answer is surprisingly simple. They don't try to predict the future. They measure the strength of what's happening right now. That's exactly what the Average Directional Index, or ADX, was designed to do. One of the biggest misunderstandings about the ADX is believing that it tells you whether to buy or sell. It doesn't. The ADX has no opinion about direction. It doesn't care if the market is moving up or moving down. Its only job is to answer one simple question. How strong is this trend? Think of it this way. Imagine two cars driving down the same road. Both are moving in the same direction. But one car is barely moving, while the other is accelerating with confidence. From a distance, they both appear to be traveling the same path. But one has far more power behind it. The market works in a very similar way. Two trends can look almost identical on the chart. Yet the strength driving them can be completely different. That's what the ADX helps us measure. It doesn't tell you where the market wants to go, it tells you how committed the market is to getting there. Now let's understand the scale. When the ADX is below 20, the market usually lacks strong momentum. Price may still move, but that movement often struggles to continue. Between 20 and 25, the market begins showing signs that strength is building. This is the transition zone. Professional traders pay close attention here, because a new trend may be preparing to develop. Once the ADX moves above 25, the trend is generally considered strong. Momentum is increasing. Participation is growing. The market is moving with greater conviction. But here's something many traders never learn. A high ADX doesn't mean you should chase the market. It simply tells you that strength already exists. Your job as a trader is to combine that information with price action, market structure, and patience. Because an indicator should never make your decisions. It should help you make better ones. The ADX doesn't predict the next candle. It reveals the quality of the move you're already seeing. And that single difference can completely change the way you evaluate every trend. Chapter 3, Reading the ADX. Now that we understand what the ADX measures, the next question is simple. How do we actually read it? The good news, the ADX is surprisingly easy to understand. It doesn't give buy signals. It doesn't give sell signals. Instead, it measures the strength behind the current trend. As a general guideline, when the ADX is below 20, the market usually lacks strong momentum. Price may still move, but trends often struggle to continue. As the ADX begins to rise above 20, momentum starts building. Buyers or sellers are becoming more committed. And once the ADX moves above 25, the market is generally showing a stronger trend. But remember, these numbers are guidelines, not guarantees. Professional traders don't blindly buy because the ADX reaches 25. They use it to confirm what price is already telling them. Think back to our earlier chart. Price showed us the direction. The ADX helps us judge the quality of that move. When both agree, we gain more confidence. When they disagree, it's often a sign to slow down. Look closer and wait for better confirmation. That's how professionals use the ADX. Not as a decision maker, but as another piece of evidence before risking their capital. Chapter 4, Reading a Real XAUUSD Chart. Now that we understand what the ADX measures, let's put it into practice. Because indicators should never be learned in isolation. They should be learned in the context of price. Look at this XAUUSD chart. Before we even look at the ADX, let's begin with price action. What is the market telling us? We can clearly see a series of higher highs and higher lows. At first glance, the trend appears healthy. Now let's ask the question a professional trader would ask. Is this trend simply moving higher? Or is it moving higher with strength? This is where the ADX becomes valuable. As the trend develops, notice what happens to the ADX. It begins to rise. This tells us that momentum is increasing. The buyers aren't just pushing price higher. They're doing it with growing strength. Now imagine you're planning an entry. Price action gives you the direction. The ADX gives you confidence that the trend has momentum behind it. When those two pieces of evidence work together, the probability of the trade improves. But markets don't stay strong forever. Keep watching the chart. Price continues making new highs. At first, everything still looks bullish. But look at the ADX. Instead of rising, it begins to flatten. Then gradually, it starts to fall. This is an important moment. Many traders never notice it, because their eyes remain fixed on price. Professional traders notice something different. They understand that although price is still climbing, the strength behind that move is beginning to weaken. Does this mean the trend must reverse? No. And that's an important distinction. A falling ADX is not a signal to sell. It's a signal to become more selective. Perhaps you avoid opening a new position. Perhaps you tighten your stop loss. Or perhaps you simply wait until the market reveals its next move. That's the difference between reacting to price and understanding what the market is communicating beneath the surface. The ADX doesn't predict the future, but it helps us recognize when the quality of a trend is changing. And sometimes, that small piece of information can keep you out of a low-probability trade. Chapter 5: The Most Common ADX Mistakes. By now you understand what the ADX measures. But knowing how an indicator works and using it correctly are two very different things. Let's look at the mistakes that hold many traders back. The first mistake: using the ADX as a buy or sell signal. Remember, the ADX doesn't tell you which direction to trade. It simply measures the strength behind the current move. Always let price action determine direction. Let the ADX confirm the quality of that trend. The second mistake: ignoring the market structure. A strong ADX cannot fix a poor trade. If you're buying directly into a major resistance level, or selling into strong support, the ADX won't protect you. Context always comes first. And the third mistake: chasing the market because the ADX is high. Many traders see a strong reading and assume they've found the perfect entry. But experienced traders understand that some of the strongest trends are already well underway. The question isn't, is this trend strong? The better question is, am I arriving too late? A strong trend doesn't always create a good opportunity. Sometimes, the best trade is the one you never take. Remember, my friend, every indicator has limitations. The ADX is no exception. It won't predict tomorrow's candle. It won't tell you where to place your stop loss. And it certainly won't make you profitable on its own. Professional traders understand something that many beginners overlook. Indicators don't replace decision-making. They improve decision-making. The biggest mistake isn't entering a weak trend. The biggest mistake is believing that every trend deserves your money. Patience isn't sitting on the sidelines because nothing is happening. Patience is having the discipline to wait until price action, market structure, and momentum begin telling the same story. That's when probability starts working in your favor. Professional trading isn't about taking more trades. It's about taking better ones. Final summary. Let's bring everything together. Today we learned that price tells us the direction of the market. The ADX tells us the strength behind that direction. Neither one should be used alone. When you combine price action, market structure, and the ADX, you begin making decisions based on evidence, not emotion. The next time you look at a trending market, don't ask yourself, can I catch this move? Instead ask, does this move still have the strength to continue? That single question can completely change the quality of your trading decisions. Remember, price tells you where the market wants to go. The ADX tells you how much strength is behind that move. Use them together. Stay patient. Manage your risk. And over time, you'll stop chasing trends. You'll start understanding them. Thank you for watching. If you found this lesson valuable, consider subscribing to Trader Classroom. And until next time, trade with patience, trade with discipline, and never stop learning.